Okay. Welcome back, everybody. Glad to see you again for week 2. Just throwing up some reminders of any of those emergency numbers in case anybody starts dying in the middle of class. I'd prefer you save it till after class if you could delay that, but just in case those numbers are here. Last class we talked about kind of just the overall overview of what we're going to be talking about. So we talked about our little 3-phase process, our simplification of financial planning. We talked about the different areas that we'll hit as we move forward and some basic breakouts of those different things. So today what we're going to do is we're going to look at phase 1 a little bit closer, and we're going to start diving into what that actually means and what each of the diagnostics really represents. So this will be really just a way for you to look at your current situation or your family's current situation, friends, whatever. Look at what you have going on right now and sort of get a little bit of an analysis and an idea of how you want to move forward. So in phase 1, we call these the diagnostics because it's really kind of just diagnosing any issues that you might have in your current finances, looking for the problems, looking for the holes that we want to fill, looking for anything that might be not quite on course with where you're trying to go, because there are a lot of times where you just might be in a situation where you don't really know what risks you're putting yourself into, and you might have a situation happen down across the line that brings you off path. So a lot of the most common versions of that are going to be something like not having the right insurance coverage and then having a loss that drags your assets down, or being too risky in the market and have your assets get drawn down by that, or not being risky enough in the market and you don't get returns to satisfy your goals in the future. So first thing that we like to start with is one of the really easy ones, personal cash flow diagnostic, which is really just a lot of words for a budget. If you look at it, it's really just taking note of all the different things that you spend your money on and getting an idea of what your cash flow is. I'm not here to tell you what your perfect rates for all of your different little bits are. There are a couple benchmarks that you can use, like in certified financial planners like to recommend you spend 36% or less of your income on housing costs overall, but we don't need to get into those details. But you basically want to look at your current expenses and add all those up and get an idea of what your life expenditure is, whether that's $50,000 a year or $100,000 a year, 150, whatever it is that your life tends to cost. We want to know what that number is because we want to know how are we going to provide that income and do we need to supplement it. Because often people will rely on things like their pension and their Social Security, and at times that can be a significant amount and cover your living expenses, but oftentimes there might be a little bit of a deficit. And if you don't plan to either cover that deficit or reduce your expenses to match your income, you're going to have a problem when you get to retirement age. So things like a mortgage, your rent, healthcare costs, groceries and other discretionary expenses, monthly utilities, your insurance payments and maintenance, car payments, all your other different types of insurance, and leisure activities. It's important to budget in leisure activities. Last week we talked about some goals which might actually be spending your money, because it's totally fine to go out there and spend your money and enjoy it, because that's what we made it for. So it's good to budget in leisure activities or other things that you might enjoy doing so that you have a fun retirement and not just a retirement. So here's an example of just what a budget might look like. This one's fairly complicated, so you don't need to get this particular, and you don't need to worry about being able to read it. It's really just showing your different salary and wage incomes, making sure you budget for your different tax needs, your other income, savings goals, and then we start getting into your expenses. But it's really just having these different categories and breaking them out and getting some decent estimates so that you can see what your total month-to-month or yearly expenses are going to be. So using something like this, you can find a lot of templates online. There's a lot of financial institutions that will give you what's called a personal cash flow statement. That's something you can also work with. And your accountants will obviously be able to help you with that as well. But really just getting all of that information into something that you can see. So you're not just trying to remember what it costs, but you actually know. That's really important because a lot of people over or underestimate what these numbers are. A lot of people like to overestimate their take-home pay and underestimate their living expenses. So having an actual calculated hard number that you can look at, even if it's just an estimate, is really useful in the planning process. when looking at your future expenses, you want to get an idea of what you're going to be planning for. So maybe that's a couple years from now, maybe that's now, maybe that's 10 years, 20 years, whatever you need to plan for. You want to be able to estimate that in some vague sense. Now, in financial planning, when we're doing retirement planning with software such as Money Guide Pro or eMoney or something like that, generally we land somewhere between 75 to 80% of your expenses while working should be about your retirement expenses. But again, you just want to look at these different numbers in order to give you an idea of what you have to do in the future to accomplish that.
Yes. So what software would you recommend for managing?
Well, for which piece exactly?
I mean, for my daily expenses and keeping track of my ins and outs, my checking ledger.
Personally, I like to just do it myself on a spreadsheet like Excel or Google Sheets. That's just what I find the easiest because I find a lot of templates or software, it just is kind of too rigid for me, and I like to break things down in my own way. So personally, I like to make my own spreadsheets, but there are some applications like Mint and Rocket Money that you can get on your phone, connect your accounts to, so it automatically reads the information. So there are some things like that, but if you don't feel comfortable sharing your login credentials, which is any random app, like
I'm using Quicken, but it has a lot of rigid things that I don't like.
Yeah, absolutely. I totally understand that. That's why I like to make my own sheets. So I tend to have sort of like a reference sheet that has a lot of different things, like a balance sheet or some living expense breakouts, and I like to do month to month on their own sheets on themselves. So just being able to use Excel or Google Sheets in just a basic capacity is really useful for that because you can kind of throw all your numbers together. That's what I like to do.
You also consider late retirement. So if they don't have long-term care insurance, position the investments for future cash flow.
Right. So that'll be something that you'll want to keep in mind is whether you're looking to purchase long-term care insurance or if you're trying to self-insure, which obviously takes a lot of assets if you end up getting there. But that's something that you want to consider as well. So all this information, all the idea of the future expenses, or even just current expenses, that'll give you direction on how you're going to invest. Because obviously, if you have a certain amount of money and you need more, you need to take on risk to generate returns and grow that money. But if you don't actually need as much as you have, you can take a safer route and possibly just try to combat inflation or generate a little bit of interest for your time and not really worry about it. So knowing what income you have to pay for and all the things that you need to do, that'll give you the informed decisions on how to invest. So if we just look at a couple different things, these are going to be really, really basic round numbers. This is not super specific, but if we just want to look at a situation where, say you want to generate about $50,000 in income every year over a 20-year span. And if we're assuming that after the 20 years you've got no money left, you spend every dollar, it goes down to zero, and you have about a yearly return of 7%. If we look at that and we calculate it, we need about $530,000 in order to accomplish that, assuming that you hit 7% returns every year. Now, we obviously like to be a little bit more generous than that, because not every year is going to be a good year. Some years are going to be better than others. So we like to plan a little bit ahead of what we're trying to achieve, but mathematically this is where we end up. Now, if we're looking at that number, and say you're starting with a $150,000 portfolio right now, and you've got about 10 years until you want to get that capital, so you have 10 years until your retirement. Your retirement's going to last 20 years, hopefully longer than that, but that's just the numbers. You're going to need closer to a 13.5% annualized return. So this just shows that the time and the capital difference is going to dictate how risk averse or risk on you need to be. So being able to know what these different numbers are gives you a much better idea of how you're going to invest. Yes?
Question, do you do projections on the conservative side or progressive?
We always like to go on the conservative side. It's always better to be lower than you need to be and get a little bit ahead of the game.
And that brings me to another question. So if you're looking at this thing cranking out 13.5, I mean, that's pretty...
Sure, that's a high return.
Yeah.
Exactly.
So are you talking your gains along with dividends and stuff? Or
Yeah, we're just looking at the overall, all of the compound growth that's happening, dividends being paid in, reinvested, all that sort of thing. So again, you can't go out and expect to get a 13.5% every single year, year over year, for 10 years. That's not going to happen. But that kind of shows you what your expectations need to be when you have these different values.
But that's not adding back in, adding to that 150,000 portfolio.
Exactly. If you were to make contributions, that would help you a long way. So that's gonna make a big difference. These are just, I wanted to keep it simple.
No, I know.
Ernie may not get that.
Right, exactly. You just get a whole bunch of
But
other
you need
people.
to find.
Yeah, sorry.
Now, this is a way to self-fund your future long-term care expenses. Even if you have the insurance, it doesn't always cover it, right? So even if everyone here is fully retired, what we're getting here is what you want to pass on to your adult children. But we all have to think in the back of our mind, what are we going to do for our self-funded long-term care, right? Not only taking care of ourselves health-wise, but what are we going to do in our investments for a later budget?
Yeah. So again, like just when you're remembering these scenarios, like we're calling back to this, which is make sure that you know what those expenses are going to be, what that cash outflow is going to be, so that you can make the investment decisions to actually compensate for that. Moving on to our insurances, there's a lot of different things that we want to look at. Insurance is one of the things where there's a lot of different things that you can cover, and it's very important to have all of that taken care of so that your assets are not attacked by losses. So we're looking at this start with that. So we're just looking at what your deductible is, your co-pays, and knowing what your policy is and what you have to do in order to keep the best way possible. Lowering your deductible will obviously increase your premiums, but if you can sustain that cash outflow, it also protects your assets. Your deductible isn't as high, that means less coming out of pocket, less coming out of investments, et cetera, et cetera. So just knowing kind of what you're planning for and knowing how you can adjust your policies in order to get a better protection of your assets might be something that you consider. Long-term disability is obviously something that's very important because when you look at the cost of long-term care, that can be really, really high. Like we're talking 6 figures a year. And if you don't have like a few million bucks, that could be really, really devastating to your investment portfolio. Be devastating to your overall picture. So that's something you really want to take into account, and also take into account how long it takes for that long-term care to go into effect. Because oftentimes there will be a little period right between when the care starts and when the policy kicks in to pay for it. So if you don't have the capital available to pay for that, you might end up going into debt to service that, and then you're going to have to come up with the cash anyway. So knowing how your long-term care also works, where it's provided, how much it's costing, what you have to do to qualify for it to pay for the care, all of those different things, what your maximum coverage is, so knowing that if you go over a certain amount, does my long-term care still pay for it? What different riders is kind of a fancy word for extra benefits that we all paying for. So just kind of knowing what is that long-term care going to take care of, and what do I have to backfill in the event that that starts to kick in. Life insurance is another one. In terms of life insurance, we're not huge fans of permanent policies or anything with investment options, just because oftentimes you're paying extra fees for something you can really do yourself. If you want the simplicity of having a life insurance policy where you also invest and you just don't really want to touch it outside, sure, if you really want to, but with the fees that you're paying and a lot of the commissions that get taken out of the value of your cash balances, just mathematically not the most efficient decision. But when we're looking at life insurance, what we refer to most of the time is term coverage. It's simple, it's just pure life insurance. You know exactly what you're paying for, you're not paying a bunch of fees on other things. So knowing how long that covers a loss and knowing when you might need to renew, or if you're going to renew afterwards, how much that coverage is. Well, a very common use of life insurance in very, very large states is something called an irrevocable life insurance trust, where you will purchase life insurance inside of the trust, and then upon your passing, if there's going to be a lot of estate taxes, if for some reason you've had way more than the exemption, which is like $13 million, you got more than that and you're expecting to pay estate taxes, you might have a life insurance policy in an irrevocable trust. once it pays up the benefit from your death, is able to pay for final costs and estate taxes and those sorts of things. But on a more basic level, looking at the average person, we are usually looking for the ability to let a family member or a spouse take time off of work, deal with the final expenses that come along with dealing with your estate, and those sorts of things. So just being able to cover that catastrophe and give some space both emotionally and financially for those people to deal with it is really important. Because if you don't have the assets to cover that, or if somebody is so distraught by their loss that they're unable to work, we don't want them to end up in a situation where, because of your death, things are starting to go downhill financially and it's like that. So that's one of the basic reasons we like to have term life.
If you have an whole life insurance policy that has $20,000, $30,000 cash value, that's an overcharge. So if you cancel the policy, you usually can get all your cash without paying taxes. So if there isn't a need for life insurance anymore, or retire, don't need it, a lot of people hang on to those policies thinking you have to. You can ask them, if I cash it out, do I get it back without paying taxes? We have a client who we encourage them to go ahead and cash it in. You don't need it anymore. They bought a Mercedes travel van, and they've been to almost every state in the country. So we like to say, if you didn't die, celebrate living by cashing it in and taking your cash out, right? Why leave the benefit to the kids? But if you had a need for life insurance, like with estate taxes, that's a big deal. Or encourage your living, obviously, children and grandkids to do all of these things. Even if they don't relate to you, it relates to them. Pass that on. Yeah.
So moving on from life insurance, we start looking at our homeowners insurance, things on our house. So obviously, just knowing, again, types of things that it's going to cover, different exclusions, what your deductible is, and being able to adjust those different values so that they don't drag down your estate too much. Making sure that obviously as much of your house is covered as possible, because we don't want to be in a situation where, sure, insurance paid for a little bit of damage, but now I have to come out of my investment account to cover the rest. Obviously, that would be a problem. So it's just like most of this ends up to awareness and knowing what is covered and what is not, so that you can plan for what is not covered or make adjustments to cover it. It really is just, you can do whatever you want to do. If you want to take more risk on the loss and lower your cash outflow for the premium, that's fine. You just need to be aware of what is the possibility of what could happen if you have a big loss and it goes beyond the amounts of coverage of your insurance policy. Now, looking at auto insurance, again, another thing where we just like to have max liability. We just like to make sure we have as much coverage as possible because, again, you have a big loss, really like hundreds of thousands of dollars and possibly a lawsuit or something like that. If your car insurance policy does not cover all of it, it'll cover what it covers, and then you're out of pocket for the rest. So you really just want to make sure that you know what is being covered, and you make sure you know you have the maximum liability for your different policies. Even though, yes, it'll cost a little bit more month to month, but a little bit more cost month to month, I would rather take than a loss of my assets that are funding my retirement in the first place. And then liability insurance in all of its different forms, knowing your exclusions, deductibles, coverages, same things we talked about for everything else. Like I said, everything is basically the same considerations. Knowing what the coverages are, knowing what the exclusions for the coverage are, knowing how big your deductibles are, and any adjustments that you might want to make in order to fit in better to your situation. So how is insurance kind of like a soup arm? This is kind of one of my favorite ways to think of insurance because every plate that you have is a different policy, every piece that you have covers a different area, and if you have the rest of your armor except your chest plate, that's not going to do so great and bad. Margin will hit you right in the heart and everything's done for you. But you might have a plate disconnect right at your elbow, and maybe there's just a little bit of space left there, and that's not going to be the worst thing in the world if you get a little weak of an arm. And so, kind of understanding that all of these different policies cover different parts of your assets and protect different pieces and protect different amounts is really helpful because then you can think, okay, well, I've got my chest plate covered, that's really good, but my head is still vulnerable, my arms are still vulnerable, my legs are still vulnerable, and I need to cover those different pieces of me to protect me from an attack, from losses, or creditors, or suits, or any of those different types of things. So again, kind of just reiterating that message where if you have your nice big pile of assets, but your insurance covers just about this much, all of those assets sitting outside of your insurance coverage can be eaten away from suits, losses, and other types of things. So everything in here stays protected because it's under your insurance policy. But all of this extra capital that you have saved up, all of the extra capital that you spent time to accumulate, to invest in, to create, have cover your different costs, expenses, goals, and all those different types of things is at risk. So we want to cover all of our assets with our insurance so that we don't have at risk to anything else other than ourselves. Because if we make a mistake, we mess it up, that's one thing. If somebody else is responsible for me losing my assets, I'm going to be pretty mad. So there's a couple different key takeaways when it comes to insurance. Maximize coverage on all policies where reasonable. If it's a reasonable cost for you, it makes sense to increase the coverage, especially if you have lots of assets. If you don't have a lot of assets, it might not be as worrisome, but then at the same time, if you don't have a lot of assets, how are you going to pay for the loss? So it's thinking about those different things, maximizing that coverage again, where it's reasonable for you, where it makes sense, cover it where it can be covered. And then when all of your policies are maxed out, the last thing you want to do is get an umbrella policy to cover the rest. Because oftentimes you run into a situation where car insurance policy, you max it out, but it still only covers so much. Home insurance policy, you max it out, but it still only covers so much. And if you've got a big brokerage account sitting on the side, it means you're not just buying a liability insurance policy off the brokerage account. So you get something like an umbrella policy to cover the entirety of your assets, so that in the event of a suit, that can pay and cover your losses. And then number 3, considering how life insurance fits into your strategy. Like I mentioned, if you already have some life insurance policies, it might be how it can come out of your strategy if you don't need it anymore. But you might be in a situation where it could be useful for you. So just kind of thinking about that, think about what problem would this actually solve. If you can't come up with a problem, you probably don't need life insurance. But if you can think of a situation where, dang, if I died tomorrow, that probably would be kind of a problem. That might be an area worth covering for a little bit of 5-10-year term life insurance. That's the whole point about insurance. Auto insurance, you have the maximum liability you can get, right? You're worried that if you hurt somebody, you'll want to lose your money. And then you have an umbrella, that's fine. But you want uninsured, underinsured motorists to be that maximum level, right? So if you've got $500,000 liability on your car, but you didn't cause the accident, you're not going to be sued. But what if somebody else did and they have no insurance? So I've had 2 cases. One client riding his bicycle, gets hit by a car, bad guy writes him a check for $15,000 from the insurance company. My client's got a broken femur, he's in the hospital, that's all he can collect. But because he took my advice back in the 80s and raised his up to $300,000, uninsured, underinsured, then his own company had to write a check for $285,000. And that's important. I have another client walking in a crosswalk, got hit by a car. And so her own uninsured, underinsured motorist provided her the coverage for, if we're retired, long-term care assistance. But if you're younger, especially your adult children, they've got to have this coverage as well as disability insurance. And then on the umbrella policy, that will make you raise the car and the house up top because they don't want to be on the hook for the first $500,000. Your house has $650,000 of exemption if you're sued, but if you have outside investments other than insured or protected retirement plans, they'll come after it. So we have a saying about insurance.
Yep, you hope it's the worst investment you ever made.
Yeah, the best you can ever hope for is that it was the worst investment you ever made. But if you don't need that life insurance, you've got cash reserves, then we got a deal for you.
You're talking about life and auto insurance. You're talking about maximum liability and UM. That's a good one.
Yes.
But also, people don't know about you have to buy medical.
Yes.
Most
Yes.
insurance companies they don't want to sell you that because they will lose with that.
Yeah.
But when you're involved in an accident, you can collect the medical money
Yes.
from your own insurance.
Perfect.
And you can collect
yeah.
more money on your settlement.
Right. Well, and it's very important, medical on your house and your car,
Yes.
right? Because if your friend gets a minor injury, maybe they break a tooth and have to go to the dentist, that could be a couple $1,000s. Your medical, they'll write a check immediately and give it to you.
Yeah, like $25,000 maximum, then cover
Yeah.
everything.
Yeah.
Otherwise, the other insurance, they won't pay for.
Right, and it prevents your friend from having to sue you to get their benefits, right? So you have a medical portion on the car and the house that you should max out as well. Very good point.
Yeah, we have several clients like that too. They don't buy the maximum liability and they don't buy UN. So, when they hit somebody else's car and they sue and they take over your assets, like we have to go over for that.
Yes.
To collect money for clients, so it's hard.
Yeah, well, it's good that you give us this advice. This is great.
Okay, so moving on to estate planning, which is something that can be very simple, but can start to get kind of complicated depending on how many assets you have and what you want to do with that, how you want them to distribute. But first of all, trusts and wills are kind of our two basic things that we always like to think of, and then we always like to think that a lot of people should have. Trusts, they are more helpful with your large estate and when you have specific instruction on things that also can help for privacy in some situations, but we'll talk about that in a moment. Wills we like to use primarily for smaller estates or kind of just like a catch-all for personal property, things you have sitting around your house if you want to say, everything in my house, just leave it to this person or split it amongst these people. It's better for when you have some things that it's not really top of mind, you don't need any crazy specificity, you don't need it to be a private transaction, you don't have a lot of assets. Wills are great. So it's always great, even if you have trusts set up, to have a will as sort of a catch-all for anything you didn't really think about. So if you have your trust set up to take care of your investments, retirement accounts, maybe your houses, whatever the deal is, you might just have some things you didn't really remember, maybe a couple computers in your home that you didn't think to specifically name in your trust. You just kind of catch all everything else in your will and let that process those smaller items. And then with trusts, like I mentioned, they're great for larger estates or for having very specific instructions or having qualifications or contingencies for different things that you want beneficiaries to do to qualify to get their assets. You can get really, really specific and really kind of make sure that everything goes exactly how you want it to if you write it into your trust. And then your executors and trustees will be they will be beholden to you to do what is in your best interest for the instructions in the trust. Beneficiary designations are kind of an easy way to get things out of probate, which we'll talk about in a minute why we don't want that. But you can obviously name beneficiaries on your insurance policies, on different accounts like brokerage accounts and homes. You can put a transfer on death policy, which just means as soon as you die, it immediately transfers to that person. It doesn't need to go through a court system. Like nothing else needs to happen. You just need to present the death certificate and sign a bit of paperwork and then it transfers over. That just makes things pretty simple. So if say you're in a situation where really all you've got is like your house, retirement accounts, maybe one insurance policy, and then your checking accounts. You can make your checking accounts transfer on death to your child or spouse or whatever it is, and that will just immediately go over. You could do the same thing with the home, and then you can put them as a beneficiary on your IRA. You can put them on a beneficiary on your insurance policy, and then everything's covered. And you don't need a trust. You don't need anything expensive or fancy to transfer things over. But if you have those transfer on death provisions, they can help get things right over to the beneficiaries without getting in the hands of a lot of other people. Durable power of attorney is something that also can become very important. So you've got both your medical, financial, and legal. Basically, this just gives somebody the power to act on your behalf or in your interest. And by durable, we mean that it continues through your incapacitation. So if you were to be in the hospital, if you were in a coma or something, if it's durable, it lasts through that event. And for somebody who needs to make a choice for you medically, if you don't want to be resuscitated or all those different things, you can have somebody step in and make the final call for you. Same thing with financial and legal. If you're out for a while, you might need somebody to pay your bills and make sure you're caught up on all your payments, your mortgage, or utilities, credit cards, and all those sorts of things. So it's important to be able to give somebody else the authority to act on your behalf to make sure all these things get paid up in full. And obviously make sure it's somebody you trust, not just somebody you thought of at the last second. So, talking about when courts get involved, we'll talk a little bit about the probate situation and why we don't necessarily prefer that. So there's
what we're kind of looking for is we're looking for a certain direction of movement with our assets. You can think of these arrows down here as our trusts, our transfer on death provisions, beneficiary designations. You've got your assets in your estate all the way over here, sitting nice and pretty, looking nice, and then you have the death event, and they get transferred immediately over to the beneficiaries with a little bit of work from the companies that they're held at. But things will move over quickly, they will move over quietly, and nobody really needs to know what happened. Nobody needs to know who got what. It's all just very clean and makes it over. But if you don't have these provisions in place, or it's an asset that gets caught into the process of probate, what happens then is that the probate courts have to look at your different assets, they have to look at your will and decide where do these assets go. And we'll talk about in just a second why that might not be beneficial. But again, you want to have a straight shot from your estate right to your beneficiaries, instead of going from your estate to the probate court, getting caught up in the probate process, and then moving to their beneficiaries. And the reasons why: first of all, in California, it could take 12 to 18 months for that process to go through. Versus if you have a transfer on death provision, you might be looking at a month or two. You might be waiting 30 days to get a proper death certificate, and then you might be hounding the bank for a few weeks, and then finally you get the paperwork finished, and then it gets over. But if we're looking at probate, it takes a year to a year and a half to conclude. That could be a very long time for a beneficiary who might be, whether they're expecting or where you were expecting to deliver an asset for a particular need. And it could be very expensive. When you're going through these probate processes, from the research that I was doing, those fees that they charge you, these percentage fees, are based on your gross assets, not your net assets, not assets after they subtract your liabilities and debts and all those sorts of things. That's on the entirety of the assets that you are transferring. So if you're looking at $1 million and the fee is 5%, that's going to be a lot of money that you didn't necessarily have to spend if you had previously spent that on a trust that could move the money right over. Probate proceedings are public proceedings. This is something that some people don't really think about, is when things go through probate, that's all public record. That's like people in the court system, and they can look at those proceedings and see who gets what exactly and how much, and they can see all of the information. And that could lead to some not as friendly conversations down the line if people are not satisfied with what they got. So that's something to always keep in mind, is privacy is very valuable when it comes to an estate, because it can keep things low key, it can keep things non-argumentative, and it's just, here's what it is, here's what you got, and nobody else has to know about it if you don't want them to. And assets can be distributed in a way you didn't intend. It's possible there could be a circumstance where the court just doesn't do it the way you wanted, and maybe they processed something differently, or maybe you forgot to specifically name something, so the court now gets to decide and hear all the arguments from the different beneficiaries, why they deserve it, and then they get to make the choice. You really want some random court in California to make the decision for you where your assets are going to go? Unless you only have one heir that makes any sense to deliver assets to, I wouldn't want that.
It gets worse. The court can actually appoint a master who is totally out of the game.
Yeah. Yep.
Yeah, if you look up, we had one client who had transferred control to a local trustee through the state. We looked up the trustee and they had been fined and in all kinds of trouble, but now they're controlling the client's money. And they can do outrageous billing, kinds of things. So that can be a problem.
Yeah, so again, it's really knowing like how much control you want to have over this process. And for most people, you want to have all of the control. You don't want to have everybody knowing who's getting what and how much. You don't want assets to just go to whoever and you don't really know. You don't want to be paying these ridiculous fees for something that isn't even what you wanted in the first place. Like that's really putting salt on the wound, is when you don't get the assets to go to the right person and you have to pay 2, 3, 4, 8% of your estate for the wrong delivery. You don't want that. And you don't want to wait 12 to 18 months to again have it go to the wrong place, pay the fee for it to go the wrong place, and it took a year and a half. That just seems like something I really don't want to go through. So making sure that you know how your assets are getting where they're going is really, really important. So there's a lot of different things that you might want to do when we're looking at estate planning. So here's 3 different categories that I like to kind of broadly put everything into. You've got your charitable giving. So if you feel like being generous upon your death or up to your death or afterwards, there's a lot of different things that you can do, like charitable LLCs, directly gifting your IRAs, donor advised funds, charitable trusts, charitable remainder trusts. So a lot of these things are either just immediately giving your assets to the charity, or something like a charitable remainder trust is something where you take your assets now, put them in the trust, and it's treated as if you gave it to the charity, but it stays in the trust and pays you a little bit of income until the trust terminates and then goes to the charity. So there's a lot of different benefits that you can get with a charitable remainder trust. And one particular situation that we were going back and forth with a lot in the office, trying to figure out whether this worked or not, is being able to, we know how the stretch IRA was eliminated, and now that's been brought down to 10 years, right, for a regular IRA. One of the things that you might be able to do, and I still haven't gotten super hard confirmation on this, but I think it is actually possible, is you leave your IRA to a charitable remainder trust. It transfers in, doesn't pay any taxes when it comes out of the IRA, then pays income to your beneficiary for as long as you want. I think it's up to 20 years you can do or something like that. And then at the end of the term, the remainder of the assets go to the charity. So it's a way to give a beneficiary that longer distribution of assets, but at the same time, they don't get all the assets. There's a particular amount of the money that has to be left over in that charitable remainder trust before it gets transferred out.
So was I right in that debate?
I'm still not sure yet. I think you might be right. I've been searching for that Internal Revenue Code for months now, and I still can't find the exact code, but someday we'll get there. So yeah, that's kind of what we're looking for with charitable giving. When we look at inheritance, obviously that's one of our main things that we're looking at when we're looking at estate planning. So things like family limited partnerships, where you might have a big family business and you're looking to transfer it. There's a couple different benefits to doing it that way. Some different, I don't remember exactly what there all is, but beneficiaries and transfer on death, again, something we talked about earlier, where it just, you having that beneficiary provision or the transfer on death provision allows the asset to transfer directly rather than going through probate or any other process. Revocable living trust, a trust that you can change and that you can modify during your lifetime, which is a good way to just put things in there. The difference between a revocable living trust and an irrevocable living trust: if it's revocable, the assets that are in there are still considered part of your estate when you die, but if it's irrevocable, you are making a decision that is not revocable. You can't take it back, and you're leaving all the assets in there, so when it leaves your estate, it's considered not part of your estate when you die. The main benefit to that is taxes. If you have a lot of assets in your estate, if you have a $20 million estate, only $13 million of it is exempt from estate taxes, you might need to get that $7 million out. You might need that to go away and be dealt with in some other fashion so that your estate is not paying taxes. So that's why you would use something like an irrevocable living or an irrevocable trust to get those assets out of your estate. Wills, like we spoke about, good way to catch some personal property or other things that are not in your trust. Special needs trusts are super useful because you can actually leave assets to special needs beneficiaries without messing with their. There's a couple different things in there that you need to be aware of, where you might be in a situation where you give them assets, but then maybe for 2 or 3 years they're disqualified for the benefits that they're receiving, and then they need to, because that might be considered income. And that's just something to consider if you have a beneficiary that has special needs and has benefits from the government. You don't want to mess with those because that can really, that can make things sour pretty quickly.
Are there special needs trusts for gamblers?
I really wish. Looking at asset protection, another really common thing that we like to use, because when you get things out of your estate or you get things in a protected entity, they become not susceptible to creditors and lawsuits. So that's another reason why you might want to move things out of your estate, because you get those assets at arm's length control, where it's not really mine, it's my trust's, and it's for the benefit of some other beneficiary. So it's really for them, not for me. So that might be a situation where you get the assets away from yourself so that, you know, those creditors and lawsuits can't come after you and then in turn go for those assets.
So who gets to control a trustee to a irrevocable trust? Who's the trustee?
Well, I mean, that'll be whoever you decide to assign. So you could have...
You would not be the one that
Yeah, so you wouldn't be the trustee of your own trust, especially if you had the power to pay your own debts and obligations, because then it would just be as if you still had access to the money anyway. So that's a lot of times you can get like a professional trustee. There are some trust companies that will do it for you.
And you can be the beneficiary. You can receive income from the trust. So if somebody were to sue you, they couldn't take the asset, but they could stand in line for your income. And in the family limited partnership, you don't see that much anymore, but it used to be that you had a family limited partnership, put all the business and the family assets in it, and then when you break it up, if somebody died and the other people had their shares, they're devalued because they can't sell them as easily. But the IRS does not like family limited partnerships because the devaluation, they don't get all the estate taxes. And that 12
you might get a bit of a benefit for putting your money in that gives you a credit on your taxes. Mutual funds and ETFs, this is kind of an interesting one that we talk about a lot in this class, and we'll talk about it in depth later. But one of the things that you want to pay attention to is when you have regular old mutual funds, they regularly disperse their capital gains that they make in their investment practices. So if you have a mutual fund that makes a whole bunch of capital gains last year and they find that it's time to sell those positions that have the gains, those gains get transferred out to you as if you made the money, because you did see the appreciation, and then they'll distribute that cash back out to you when they make the sale. So there are situations where if you have a trust account or just a regular individual brokerage account, not like a qualified retirement account or anything, where those distributions might surprise you when it comes to tax time and you file your 1099-B on your tax return. You might be surprised that now I owe a whole bunch of capital gains taxes on these distributions I didn't even know I was going to get. So one thing that you can do is you can look at the different mutual funds in your investment accounts, again, in your non-qualified investment accounts. You can go to the fund company's websites and find the schedules of when they regularly put out those capital gains distributions. You can kind of get an idea of what you're going to be getting. That's why oftentimes when we're looking at talking about trust accounts or individual accounts, we really like to use ETFs, because even though sometimes they will pay out dividends, they oftentimes, most of the time, don't pay out capital gains, because they can do some fun little trickery to not have to pay those out to their investors. So that's why we prefer ETFs most of the time in non-qualified accounts. But if you really want to invest in those mutual funds, put it in your IRA, Roth IRA, other qualified accounts and stuff like that.
You can be hit at the end of the year, right? If you buy into a mutual fund in early December and you didn't own it long enough, but they kick out, you pay $10 a share and now they drop your share to $9, but they give you $1 back. That's your own money, but you get taxed as though it's a gain. So you got to be careful with that. Year-end tax planning, like that's brilliant, is having your mutual funds in your IRA and your exchange-traded funds that are more efficient outside of it. But there are mutual funds that have indexes, right? Index mutual funds that are fairly tax efficient.
Sure, yeah, and because those are indexes, they're very stable investments. For the most part, you won't see a lot of capital gains distributions, but it is possible that if an index changes and you have a big gain position, you're going to have to sell it off and move it anyway.
And the tax advantage investing, the legal department didn't let us say tax-free investments. So those are municipal bonds.
Yeah, municipal bonds and treasuries and things like that, where treasuries, you're not going to pay your state taxes. Municipal bonds, you're not going to pay your Fed taxes. And if it's a municipal bond from your own state, you won't pay any taxes. So that's kind of nice. But if it's California, you might be a little worried that our budget isn't exactly as pristine as it could be, and you might be a little worried about...
Mutual fund or munis in California.
Yeah, I mean, I look at some of the positions on some transferred in investments on municipal bonds, and they are not doing amazing. They're not doing great. They're at pretty hefty losses some of the times. So that's something to keep in mind when you're looking at tax advantaged investments, is what are you trading for that tax advantagedness, and is the return worth it? Because one thing that you want to consider when you're looking at tax-free or tax-advantaged versus a taxable return is you have to see what the equivalent is for each side. If you're getting 10% over here, but you're only getting 4% over here, you might want to think about your tax bracket. And if you're not paying very much in income taxes, I'm going to take the taxable return because it's not going to reduce it by an amount that brings it all the way down to the tax-free investment. So it's just, you want to do a little bit of math when you're considering those things. Tax-deferred investment vehicles, we've all heard about these. These are super common. You probably have one yourself. I would imagine almost everybody in here has one. Your IRAs and 401ks, and the whole meaning of tax-deferred is you're putting the money in there now to not pay taxes on it today so you can pay taxes on it later. You're not avoiding anything. You're not getting rid of any tax liability. You're just deferring it to a later date. That's why things like IRAs and 401ks, you get that current deduction for the money you put in, but then you pay taxes on the money as it comes out. Roth accounts are similar to these tax-deferred investment vehicles, but the difference is you pay taxes on the money going in and you don't pay taxes on the money going out. So the two different situations where these might be most beneficial is if you have high income, getting the current tax deduction might be better for you than taking the tax-free distributions from your Roth account at retirement, because you'll probably be paying less taxes when you get to retirement, depending on your situation. And if you are a much younger person, somebody like me, for example, if you've got a lot of time until retirement, it's very worth it to get those dollars in right now if I'm not at peak earning potential. Get all of those dollars in at this tax, let them grow for decades and decades and decades, and take all the earnings out tax-free. That's where the big benefit for Roth accounts comes in, is for younger people, or if you're setting up an account for somebody younger or having them inherit it. That's where you can get a lot of that benefit from a Roth account, is when you have time on your side.
And then trivia. CARE 2.0.
Secure Act? Secure Act 2.0?
Yeah, Secure, okay.
Yeah.
Do you remember that part of the excess, when you get to be 50, when you do an IRA or a retirement plan or 401k, you get to contribute extra money, catch up? We've all heard about that? Yeah, and so you can do a catch-up if you're over 50 in a couple of years if you make, do you remember reading this?
It was $145,000 in wages.
Okay.
Yeah, so if you make over $145,000 in wages, at a certain point, they will start disallowing the catch-up contribution as a tax-deductible contribution, but you will then be required to deposit it into a Roth account, which is a really interesting change, and I'm not really sure what that accomplishes.
Well, the government gets more tax money, right?
Right now, but then they'll get less of the earnings, so that doesn't really make any sense to me.
Nobody's old enough to have 50-year-old kids, but you may have friends or somebody else. It's nice to know this trivia that if they're bragging about their catch-up clause and they make $145,000 or more, they what?
It's a 280 joint.
I know.
I'm not sure about that.
I would bet individual.
Yeah.
Sole proprietors don't have that catch.
Yeah, it's really interesting. 1099 income doesn't count. So self-employment, investment income, capital gains, all that kind of stuff, that doesn't make any change to it at all. But if you make 145 in wages, then it does affect you.
I guess I want you to fund your retirement, so I put it in the Roth.
Yeah.
Fund yourself.
Yeah, and the Roth is great, but we lose the tax benefit. If you're 60 to 63 in a couple of years, then that person will be able to do 150% of their catch-up provision. Because for some reason that age group is special.
Yeah, I love how it's always these really small windows. Like you few people get this amazing benefit, and the rest of you, don't worry about it.
Some are more special than others.
Yeah, but I think they got shortchanged with something else somewhere on Social Security. But instead of $7,500 maximum, they get to do $10,000 or something.
Yeah. Yeah. Okay, so here is kind of a stair step of a bunch of different tax advantage things or tax efficient things that you can do if you're just looking for a place to start. This would be something good that you could show to somebody who's just starting out their whole savings and financial career and all that kind of stuff. So each step in this illustration takes you up the stairway to heaven, to efficiently invest for tax reduction. I consider those the same thing. Each of these steps is listed in order of importance, building from the foundation up. So utilize the funds at the bottom first and build up from there as your dollars to invest and your experience grows. The first 3 steps remain liquid with no or limited taxation, which is good for emergencies, unemployment, home purchases, really anything you got to do with cash. So not listed here is one of the most tax efficient vehicles, the Health Savings Account, or HSA, which isn't available to everybody because there's a couple different qualifications. 1, you got to be working, and 2, you need a high deductible health insurance plan, which actually I found that the qualification for high deductible is actually pretty low. My deductible is several times higher than what they consider a high deductible plan, so I find that interesting. A lot of people I know have insurance plans that are considered high deductible to the IRS, but don't specifically state it on their policy. But that's one of the best things that you can do because you put money in tax-free, and then if you spend it on a qualified expense, you spend it tax-free. So that's a double tax benefit for you, especially if you get earnings, because if I get a deduction for the money I put in, then I earn money on that money, then I spend it on a qualified expense and don't pay taxes on any of the different ways, that's one of the most tax efficient things you can do because you literally never paid taxes on those dollars, except for maybe some payroll taxes here and there. So starting off, we've got things like tax-favored money market funds. You're not going to be getting huge returns from these. Don't expect this to be your retirement portfolio, but you can put a little bit of money in some tax-favored money market funds to generate a little bit of low tax or tax-free income. Just a little bit of interest on your accounts might be a little better than a bank account, a savings account. You've got tax-favored index or ETF income funds, so things like municipal bond funds or other index funds that don't do a lot of trading, so you don't get a lot of capital gains or lots of dividend distributions. You might have some other tax-favored investments. There are specific funds that make it their objective to save you on tax dollars. And then you've got tax-managed growth funds, index or ETF funds. So the thing about growth funds and index funds and ETFs, when you're looking at growth, you're looking at companies that are hoping to grow further and further, and generally those companies don't pay dividends. So when you're looking at a growth fund, say a tech fund for example, you're not expecting them to be a profitable company, you're not expecting them to pay out dividends, you're not looking for earnings per share or any of those fundamentals, but you're looking for a sector that can grow in value. And when you have something like that that grows in value but doesn't pay income, you're not likely to have any tax consequences for holding it. At the end of the day, if you sell it for 150% return, yes, you'll pay taxes there, but on the way there, you're not going to have any tax liability kicked out to you unless they start paying dividends. So that's why we use growth funds when we're looking for tax-efficient ETFs and index funds. And again, like we mentioned, those index funds don't do a whole lot of trading back and forth. It's not an active strategy. It's buying the index, and the changes really only happen when certain stocks fall in or fall out or fall into the indices that you're tracking.
The growth funds, I learned something last year when the stock market, the technology funds dropped a lot, remember, about a year and a half ago. And some announcer was talking about long duration stocks. And I'm thinking, what? That's long duration is for bonds. But they pointed out that growth funds that have technology, those are long-term horizons and long duration. Well, if interest rates go up, long duration stocks and bonds drop because people give up and they rush over to get this little quick fix of 5% CDs or something. So this is a long duration investment, as you're pointing out.
Yeah, so one of the things that might be helpful to explain that is the way I like to think about duration is it's kind of a way that you can gauge how quickly an investment pays you back for the money you put in. So if you have a higher interest rate, the higher your interest rate is, the lower the duration is because it more quickly pays back that capital. So if you've got a 10-year bond, but it's got a 7-year duration, I like to vague that it's paying enough interest so that when you hit 7 years, it's like you got all your money back anyway, and those extra 3 years are just fun gains you get to enjoy afterwards. So that kind of relates it to that stock idea where it's going to take longer to pay me back, but if interest rates go up, I could get paid back quicker, possibly, if I put it into an interest-bearing investment. Tax-deductible retirement accounts, like we mentioned, you get those straight-up deductions right now as you put it in. So that's really tax advantage for your current day expenses because you lower your tax liability. Personal residence can be something that's useful. As you know, your mortgage can be your mortgage interest can be deductible up to $750,000 of home, and there's a couple other benefits that you can use with your personal residence. We get to our Roth accounts, like we mentioned before. When you have time on your side, yes, you pay taxes now, but on all of the earnings and all of the dollars you make in that account over the next years, decades, however long it is, all of that comes out tax-free. So even if it's not as efficient today, it'll be a lot more efficient in decades from now. Tax-deferred annuities, some more, you're looking for those no-load, low-cost. While we don't really recommend annuities, a lot of the time, if you've just got all this extra money and you need something to do with it, a tax-deferred annuity is not always the worst option that you could use, especially if you find something that has no load or is low cost and isn't just taking a bunch of fees from your investment, where you could otherwise do it in your own accounts. Other things like commercial real estate could have some benefits, but obviously you need to know what you're doing in that sort of area, or you just have, again, lots of extra income that you just need something to do with. Maybe you're just really bored on Sundays. You got your personal business, which can be one of the best things for reducing taxable liability if you're able to actually invest in things that will increase the business. But again, it's all the way up there because of the risk that it holds. So if you're not going to just tell somebody who's making a little bit of money to take all of that money and spend it on personal or spend it on business expenses to get rid of the tax liability and then just lose all the money. That's not really helping anybody. But if you have the ability with extra income to invest into things that are going to grow your personal business, get the deductions or get the depreciation, all of those complicated things, that might be useful for your tax situation if you've got extra income. So again, you start in all the way down at the bottom, you're building up this foundation with your tax-favored money market funds that can cover your emergencies, cover your cash expenses, things like index funds and ETF funds for income funds, which might be a little bit more volatile than your money market, but aren't going to be flying up and down like a growth fund or index fund, and all the way up until you build this nice, big, tax-efficient investment portfolio. So those are a couple things that we like. Yes?
The personal residence, 750,000.
Yeah, so when it comes to mortgage interest, you can deduct the interest that you pay on your mortgage, but only up to a value of $750,000. So if you've got $1 million house or $1 million mortgage, that last $250,000, the interest that's associated with that isn't tax deductible for you. And then the other thing with the personal residence, you can also, when you have gains on your personal residence, if you've lived there for 2 of the last 5 years, you can exclude $250,000 worth of gains on your personal residence per person. So that's pretty useful. So you can go up to $500,000 if you're married, and you can have $500,000 of gains and not pay any taxes on that, and then go buy yourself a nice bigger house. So that's something that's kind of useful.
Provision for property tax.
Yeah, so that's the other thing. There's a SALT provision. What does it stand for again? State and local taxes or something like that?
Local taxes, is that right?
Yeah.
Okay.
Yeah,
Oh,
so
limits it, right?
yeah, so you'll have a limit of $10,000 that you can deduct over on your tax return. So
State and local.
yeah, state and local taxes.
Property.
So yeah.
One more question.
Sure.
The primary residence, when you say the 500,000, can you like buy another primary residence after 2 years? You can sell and you can deduct.
Yeah, so you can just keep going over and over again. It's not like a one-time thing, but you just have to qualify. So you have to have lived there for 2 of the last 5 years. That's where you're going to get that.
You can sell any real estate property with huge gains, tax-free. There's one thing you have to do. You have to die.
Yeah.
No, I didn't know you had it. That's one shot, but you can keep
No,
having
you
the
can
primary
keep doing that,
residence.
yes, for the last 5 years.
Yep, as long as you qualify, you still get that exemption every time.
And if it's a rental, 1031 exchange rate.
Like that 1031.
Yeah,
You
yeah,
have that.
doing a 1031 or rental is great, but you got the sales commission, the escrow fees, and the new property taxes on the next property. But on a 1031 exchange, those of you that have a broker saying, have I got a deal for you, we can do a Delaware 1031 exchange. They want you to sell your property, transfer the money to this big, massive real estate limited partnership, avoid taxes, but now you're just one little investor in there, and they'll pay you what they think you deserve. I wouldn't do that. Do it yourself.
Yeah. Anything that sounds like too good of a solution for your problem is usually too good to be true. So I would.
They get too big. We saw that in the 80s. Remember, limited
So moving on, something that we can think about is Roth conversions. This is something that people talk about a lot. There's a couple reasons why you might convert and a couple reasons why you might not. So let's take a look at some of those right now. Reasons why you might want to convert into a Roth IRA right now is if you are retired and you're in a lower tax bracket than you were when you were working. So if you are in a situation where you're paying less taxes now than when you were putting money into your regular IRA, you can take that less taxes, you can pay that lower tax rate and then push it into the Roth IRA so that later when it comes out it's tax-free. If you retired later in the year, you can defer some current income, deferred compensation, or defer a pension until the following year. When you want to pay the conversion taxes for the benefit of your future beneficiaries. So you might want to take your IRA, convert it into a Roth, pay those costs for them, then they get the tax-free benefit of the Roth distribution. So that can get kind of smart if you just feel like you want to be the one to pay those costs for your beneficiaries, not have them worry about it, and just give those benefits tax-free. And if your future income is going to be higher, or you're worried that tax rates are going to keep rising, that might be another reason to convert to a Roth IRA, so that when you get to that situation where your income is higher or the tax rates are higher, you've got tax-free distributions rather than taxable IRA distributions. So there's a couple different things to think about, but really the thing that should tell you the most is what your tax rate is going to be, your effective tax rate. If you think your tax rate's lower now than it's going to be later, do the conversion. If you think that if you want to pay the conversion taxes for your beneficiaries, then go ahead and do that. Those are a couple reasons you might do that.
It also helps you, if you did convert some, if you can afford to, it reduces the size of your future distributions, right? Because your big IRA is over here, and if I transfer some over here, it's now smaller, a little bit less at that point. And then on the Roth conversion, you don't have to pull it out at any time, but your beneficiaries have to pull it out within 10 years.
Yeah.
Not taxable.
So a couple reasons that you might not want to convert to a Roth IRA is the tax liability will move you up to a much higher tax bracket. Because remember, as money comes out of an IRA, that's not a capital gains tax, that's not investment income, that's ordinary income. That's going to apply to your tax return and raise your taxable income. So if that's going to push you to the next tax bracket, it might not be as worthwhile as it would be if you were able to stay in the lower one. So if you were moving from 24 to 27 or whatever bracket it's going to be, you might want to look at that and think, how much extra liability am I going to be taking on for these extra dollars versus how much I'm going to save by converting it now. You might not have the money for the taxes set aside. So one thing you're going to want to keep in mind is when you take that money out, you want to put all of it into the Roth IRA. So you're going to want to pay those taxes out of pocket. Yes?
So I have a question. If you, let's say your RMD is $30,000 and you have a traditional IRA, could you take out your RMD as $30,000 and put that into a Roth IRA? Because
So
at that point, I mean, it's going to be regular income anyway.
Right.
Because you have to take it, and then you could take it and then put it in a Roth IRA.
Right.
Let's say, assuming you don't need that money.
Right.
I would be cautious, confirm it, because they've gone back and forth, but in the past they said you had to take the RMD, then you could do the Roth conversion, so you've got a double amount of money coming out. That's my understanding. But check on, yeah, well, if they say you have to do the RMD, you have to take it, and then if you want to convert the principal of what's left, then you've got that plus the RMD.
Yeah, I just talked to Daniel about that, and they said, if you are at an age where you have to take RMDs, first money out, you can't convert it into a Roth until you satisfy your RMD
so that answers
for the year.
Yeah. One other bit of trivia you need to know is if you're going to do a conversion, do it 2 years before you have to do your RMD. Why would that be? Because if you're going to, let's say 73, you have to start doing an RMD, right? Make sure that you do your conversion at least 2 years before then, because your Medicare reassessment, they'll go back 2 years, right? So do that before, and then 2 years passes, then they don't up your Medicare.
Yeah.
Same thing with real estate. We sold a rental house, and what they quoted us for Medicare, when our premiums came in, they were twice.
Because you was, yeah, that's.
Yeah, so before you do anything, and then real estate has
that net investment income tax of 3.8%, that must be not fun to do. So yeah, before you do anything, see the accountant run the numbers and then just make sure that you don't get into trouble. But 2 years prior to that.
Well, no, we were 63 when we sold it, and we didn't realize when we was getting Medicare 65, I was doubled because we have capital gain. Nobody told us that, and everything doubled. I don't think.
You can also ask for a reconsideration. No, actually, they go back 2 years, and then this year your income's gone down. You can ask for a reconsideration.
Yes.
But you have to do it 2 years in a row because they won't do it the second year unless you ask again.
Yeah.
Yeah.
Great stuff.
Yeah, so again, all of these little circumstances are why, like I mentioned way before when we were talking about whether you want to do your own or whether you want to hire a professional, make sure you're as qualified as the person you want to hire so you don't miss things like this. Another reason you might not convert to a Roth IRA is if your tax rates aren't any less than they were when you contributed to the previous plan, because you're not really going to be getting that much benefit if you're going to pay the same taxes anyway. Then you're going to convert them over unless, like I mentioned, you have that time on your side. Then it could mathematically be better, but again, if you're not really saving any money, if you're not in a better situation to do it now than you were previously, you might not convert. Those are our reasons to convert and not to convert. So a couple things that we'll talk about now is when we talk about our real estate tax deductions. When you're looking at your personal residence, you'll have your loan points on the first mortgage, so you might be able to write off some of those. You want to talk about that a little bit more?
Well, and tell your kids that they're buying a house, right? We already know that they're going to get a loan. Rates, you might be refinancing, so maybe we wouldn't do this now, but when rates were low, you prepay extra interest because it's tax deductible. So if you pay points on a loan, it's deductible up front. But with rates high and you might refinance, I would rethink that. But that was one possibility. If you refinance, you don't get to write off any points.
Yeah. Again, like I mentioned, mortgage interest is deductible for most homeowners on the first $750,000. So like I mentioned, if you've got $1 million mortgage, you can only deduct the interest on $750,000 worth of the mortgage. So if you've got more than that $750,000, you'll have to do a little bit of a calculation for an inclusion or exclusion ratio to kind of figure out exactly how much of that you can actually deduct. Obviously, up to the SALT tax limitations, which in California is up to $10,000, which is where those property taxes are deductible within certain limits. Improvements into your personal residence can increase the basis, so you're not getting any immediate tax deductions or benefits for doing that right now, but if you're doing actual improvements and you're raising the value of your property, you will increase your basis along with it so that the place from which you start to pay gains moves up along with you. And then obviously you're also increasing the value of your property, which can be beneficial. Then you combine that with the Section 121 capital gain exclusion, which is what we talked about a little bit before. Maybe a lot of those gains that you got from the improvements can then be written off when you sell the house. So those are a couple different things you want to put together. And then obviously you've got the ownership test, which is, do you own the property? That should be pretty easy to figure out. And then you've got your use test, which means that you've lived in it as your principal residence. That's very important, as your principal residence for 2 of the previous 5 years. And that will qualify you for the Section 121 exclusion.
And improvements on the house, as you know, will be reassessed, right? Your property taxes will probably go up, but only on that part of the improvement, unless it's a repair.
And then obviously the best possible thing you can do for real estate tax deductions in your personal residence is die, because then you get a step up in basis after death. And whoever gets that property gets stepped up, and then if they live there for 2 of 5 years, then they also get that exclusion.
If you have a legal spouse, you're married, if one person dies, if the house is held in community property, and then the capital gains is waived for the surviving spouse. So we can talk about that later, but you either have a living trust that claims community property if you're legally married, or if not, the house should be a community property in the state of California. If one person passes, the survivor gets to scoop up all of the gains and either sell at that point or sometime in the future, and the basis gets raised.
Yes.
So when the improvement increases the basis, do you keep receipt, or how is the best way to capture?
You have to appraise the house, because if you choose not to sell it, right? If one spouse passes, you have a low purchase price, that person dies, they raise the purchase price now for the survivor, so you have the house appraised, and up till that point, there's no capital gain.
But I'm saying improvement, like you say, home improvements? Is
Oh,
that-
yeah, keep your receipt. Yeah.
Okay.
That'll raise the cost basis, and hopefully the county doesn't really come in and, tax you for the improvement.
So you just keep it until the time you sell it, then you just show.
Yeah, yeah,
Keep good records.
yeah, yes.
Can I ask one more question, because I've been thinking about this. If you own a house for a lot of years,
Yeah.
I was thinking, I haven't had a good system of keeping track of the basis. And,
Yeah.
you don't wait for another umpteen years and you say, oh my God, how are you going so it seems like I should have a process. Does anybody have a nifty solution? Every year when you're doing taxes, collect and add, keep a running something. Unless you do that, you got a mess. It becomes relevant.
The one way you can solve that, have a very creative tax person. And they'll come up with it, because the government just wants the tax right or whatever.
Do you have to live in the house any time within the 2 years consecutively within the 5 years before, in the beginning, or the after?
It can be
Does it matter?
any 2 of the 5. So you could be the first and the last, or you could be consecutive, or you could be 4 and 5.
24 months straight.
Yes.
Okay.
Yeah, it will be. But you'll want those full 2 years.
You have to cover them straight, okay.
Right, yeah, yeah. Yeah, so it's just, like you just want to have the equivalent of that
If
time.
you
Yeah.
have a rental property, if you move to it for 2 years, we can sell it rather than do a 1031 exchange.
Correct.
Yes, and I'm told that you might even avoid the depreciation allowance that you owe. So confirm it with an accountant, but I was shocked to see that if you move.
Important things when you're looking at your investments. Yeah, fees matter, like the fee ratio and all these different things, expenses. That's all important in its own right, but for the most crucial things is knowing that you're taking the right amount of risk for the period of time that you have going forward. If you're taking too much risk, you might end up in a situation where you don't have the right amount of assets. And if you're taking too little risk, you might end up in a situation where you don't have enough assets. So those are the 2 main things that you want to look at is how long do I have for these investments to work, and is the risk that I'm taking appropriate for the period of time that I'm looking at. Then obviously we talked about our Roth conversions, a couple reasons why you would, a couple reasons why you might, and why your tax bracket, your effective tax rate is probably going to be your best signal for whether it's a good idea for you or not. Or, like we mentioned, if you want to pay the cost for beneficiaries today so they don't have to. Tax deductible contributions, obviously you get those tax write-offs today for putting the money in. Tax-free returns, which I don't know how the legal department let us get that in there, but we'll take it. With your municipal bonds and other things that don't generate a tax liability, those things can be very useful. Tax deferred earnings, like putting it into qualified retirement accounts, like 401ks and Roth 401ks and IRAs, like we mentioned earlier, ways that you can push those earnings, push those taxes to later dates so we don't have to deal with it today, because if I don't look for long enough, it just goes away, right? But tax credit investments as well, things like we mentioned, those solar credits, subsidized housing and things like that, where you get a benefit for putting your money in there today because you're doing something good for the community or the economy. And then there's a lot of knowledge that you might want to pass on to your younger generation, things that you might want them to know, like that stair step that we mentioned, all the different steps that they can take to build a tax-efficient investment portfolio. Obviously, you want them to build up their cash reserves because you want people to have the proper amount of cash set aside for an emergency or some other cash need. It's shocking when you look at the statistics of how much the average American has saved up and how a very scary percentage of people could not come up with $1,000 if they needed to. And a lot of that is younger people like my age. A lot of people around my age, even 10 years older, are just absolutely cash poor and heavy on debt, especially consumer debt. That's a really big problem. The balances of consumer debt just keep going up and up and up, and the rates keep going up along with it. I mean, seeing credit card rates that people are getting offers at like 30% interest. If you carry that balance, that is horrible on your balance sheet. And so being able to actually have that cash reserve to be able to pay for things and not have to put it on a credit card, not have to take it out of an investment account, not have to take money. I can't tell you how many people my age think it's just totally normal to pull money out of their retirement accounts and just pay the penalties and taxes on it and then use the cash because they need it. It's shocking to me that people don't understand how much they're mathematically giving up by doing that. You're giving up all of these compounded returns and all of this time value that you could have held if you just put that off. Investing in liquid and tax-favored reserves, very similar to our cash reserves, making sure that you have assets in things that are liquid and available for you if you need it and can give you returns that don't impact your on a heavy amount. Home purchases can fit into this. Nowadays, it's really hard for somebody to be able to afford a home because home prices are skyrocketing, wages are sitting kind of flat. But if you can get into the position where maybe you can help a child acquire their first home, that could be a very big benefit for them moving forward. Maximizing the deductible on your insurance policies and stuff like that to keep them, to keep their rates low and premiums low and things like that. Retirement plans, making sure that you maximize your contributions to your IRAs, Roth 401ks, Roth 403bs. Young kids should be contributing to Roth accounts, especially if they're not high earners right now. Have your kids contribute to Roth accounts, and in fact, if you want to, you can contribute to Roth accounts on behalf of your children. They don't care where the money comes from as long as it gets in there. That's all right. You can give your kids a gift to put it into their Roth 401k or Roth IRA and give them a nice little head start in life. Yes?
They're already contributing to a regular IRA or 401k.
Sure.
Can we still contribute to a Roth?
So there are some restrictions. A lot of the times it will be income-based, but also if the person is an active participant in a company plan, that will disqualify them for getting the deductible contributions to IRAs and stuff like that. But there are some things, I think you could still make a taxable contribution to retirement accounts.
Yeah, and a lot of people will do an IRA contribution and not get a tax deduction. And if they don't have any other IRAs to mess up the calculations, then in 30 days they convert that to a Roth. It's called a backdoor Roth, right? But be careful because that conversion of a non-deductible IRA to a Roth could trigger taxes on other IRAs hanging out there. So again, you want to watch out because they run the numbers. Yeah, if you have a 401k and you don't have any other IRAs, then you set up a non-deductible, convert that to a Roth, everything's fine. But if you have an IRA sitting around or a 401k that's now a rollover IRA, and you want to contribute to a non-deductible IRA and convert that to a Roth, they're going to consider that big other IRA as a part of the deal, and so you're going to pay some tax.
And the protections change from the 401 to an IRA, so you either have the risk on one side and you don't.
Yeah, very good point. If you do a 401k rollover to a rollover IRA, fine, keep that separate from any other IRAs because that 401k has lawsuit protection, ERISA, Employee Retirement Insurance Act. So your rollover IRA is fine, just don't commingle that with other contributory IRAs that you did on the side that didn't have that liability protection. Because if you get sued, they can't take your rollover IRA if it's part of an old retirement plan. Thrift savings account or 401k or anything else. They could stand at the door and try to take the income, so that would be a good thing to do that.
Is that true of 457s also?
Yes, 457 can be rolled to an IRA and it retains its protection. And some people argue that in California, IRAs are protected. It's up to the judge because it's your primary retirement. And if you do big real estate investments, you can set up a California, what is it called?
California Private Retirement Trust?
Yeah, I have it. I have all my rentals in a California Private Retirement Trust. They're all wound together in an LLC. The Private Retirement Trust owns the real estate. It's not a tax deductible event, so if my rentals produce income, it goes through the LLC to me. I pay tax on it, but if you sue me and come after me, that's my non-tax deductible qualified retirement plan that started out at the same time ERISA did. So if we have anybody that has massive amounts of real estate and wants to protect that in addition to umbrella policies, you have a California Private Retirement Trust. We're familiar with it.
My question on 457 is if it also enjoyed ERISA lawsuit protection, like the 401k. I mean, in deciding whether to transfer those 4Os into outside IRAs?
I would say yes, but I would want to confirm, and I'm quite sure it would.
Problem.
The thing about deferred comp with the state of California is not a problem, but if you have deferred comp with a small employer, that's deferred to you. So if they go belly up, you're going to lose that deferred compensation with a small company. State of California, I wouldn't worry about it, but deferred compensation is on the books in their assets, so they could be snapped up in a bankruptcy.
If the company puts your deferred comp in a Fidelity account, could they go after it? Or
I don't think so, no, because I'm assuming deferred comp is covered by ERISA. If it wasn't about it, that would have been news. That'd be great trivia to say, oh no, you're not. But I think I'm going to guess that it is. And you can, like we say, we can roll that to a rollover IRA and maintain that protection. And inherited IRAs are not protected if you get sued, and nor is a Roth, I don't believe, has that ERISA protection. It's just your primary big lump sum rollover through a savings plan and these other big ones that you guys have, so you don't have to worry about that.
Yep.
But the last thing about doing the Roth conversion, you could swear up and down that taxes are going up, and that could be a reason in itself. And if we're past the age of getting Medicare, we're already getting it. I guess if you're past the age of getting it, you're dead.
Yeah, probably.
But if you're really convinced that taxes are going to go through the roof, that's another good reason to consider doing it. But like Nash said, it's going to dwarf the investment, stunt the growth of that if all of a sudden you lose a third of it.
Right. Yep. Again, a couple other things we'll just get on before we end. Wills, you want to make sure that your kids know about wills and know how to set them up and make sure that their assets are all covered. For small estates, they're great. Child custody, they can help out. A couple other things. Some other things, adding the trust in, especially for mixed marriages, combined families and stuff like that. Trust can be super helpful because then you can direct the assets properly to each different member of the family. Whereas when that goes through probate, that's going to get a little tricky. And we just don't want to let the court deal with that, especially if maybe you love one family a little more than the other. Loss of both spouses could also be a really tough situation to deal with in terms of planning, but if you have a trust that can account for that situation, it can cover that. Parents' life insurance proceeds, that's another thing that can be handled by the trust, especially if it is the beneficiary for those proceeds. Incapacity, you can have a lot of things be taken care of when you're not there and not able to because you're assigned trustee, executor, all those sorts of things can help out. Durable power of attorney, super helpful to make sure that you have somebody that you trust able to make decisions for you when it comes to your health care or your financial needs or legal needs. Making sure that people are well up on document storage and cybersecurity. That's something that we have to do a lot of training, and we have to have a lot of knowledge about because everything is digital these days. That means everything's also vulnerable. It may be hard to wrap your head around, but there's a lot of different things that you need to do and a lot of different things that you need to protect yourself when it comes to document storage and cybersecurity. So one thing that we like is having both hard copy and digital storage. If digital storage fails, you should have a hard copy of something really important as a backup. And like we like to call that the difference between hot storage and cold storage. Hot storage is basically something on a device that's running, and so that can be taken down at any point. But if you have cold storage, you're thinking of something that's disconnected in a detached way in something else. So even if you just have something on your computer, maybe you should have the latest backup on a hard drive that's in a safe. But then at the same time, if you can have it in paper form, that might be worth having in a safety deposit box. It's just having those different layers of protection so that if something fails along the way, you have something to go back to. Having trusted contacts on your accounts, so somebody that we can, as financial professionals, that we can contact available, whether it's to just figure out where you are or maybe pass along some information that needs to get to you and we can't contact you. It's good to have those trusted contacts on file. Password storage is something that I fought really hard to get implemented at our office, and I'm very, very glad we have now, is having a password manager. So you'll have a lot of different passwords for your bank accounts, for pretty much everything, whether you're looking at your Credit Karma, your bank accounts, your investment accounts. You're going to have a lot of different passwords. And some people, definitely not me, get a little lazy and use a repeated password across a lot of those different accounts. And the problem with that you might think you have a really good password. I thought I had a really good password, but then one account gets breached, and the person who breaches that account is going to try it on your other stuff too. And if they find out that it works, they might have access to a lot more than you thought they would. Sure.
So the password manager, what if they get hacked?
Well, generally what happens is the way that that's stored is something that's not going to be as vulnerable so it takes a really complex breach of their security to get access to your files. Because what happens is they're stored kind of arm's reach from the employees at the company versus for you. So it's in an encrypted little bubble that all gets stored at, where you're the person who has the key to get those assets out of there. So they're not actually accessing your data. So if the company doesn't have direct access to your data, it also means that if that company gets breached, they don't have direct access to that either. They're still going to have to break through the encryption. Sorry?
Possible to breach, but more difficult.
Yes, correct. So it's still going to be better than if you just have similar passwords, or you just like have it written down on a notepad or in a notepad on your computer or something. Because of the encryption that they'll have, it will be another layer of protection. And the thing that I like about our password manager as well is it lets you randomly generate passwords and save it there so that even you don't know what your own password is. Sometimes that could be kind of helpful. Then you'll usually use like a master password to access your list, and it'll log in for you. We like using Dashlane. It's been super helpful, and I like it a lot. You can store all there, obviously. You can store some secure files on there as well. And it also comes with a free VPN if you ever are interested in that.
They're now doing different security methods to where you can, they have a little link. So when you go to the bank and say, okay, I want to look at my account, and they say, okay, here's your number, password number, and you get it in your text. That's a vulnerability now, right?
It can be. So there's something that should be known about when it comes to text message security codes. It has been previously much better than not having any what's called multi-factor authentication, which basically means a bunch of different factors. Your first one is your password, a text, whatever. But one of the vulnerabilities with a text form of two-factor authentication is something called SIM swapping. That's where a person can basically direct the messages that come to your phone to their phone. And then as soon as they have that access, they just go on, say they forgot your password, get the two-factor sent to their phone, they put it in, they have complete access. So that's a thing that is possible to happen, which is why we like things like basically those code generators that you have installed on your phone or on your computer, where you link the profile. So instead of it getting sent from the institution to you, it always knows what the matching corresponding code is, and then you use that instead of having it go over this vulnerable cell phone contact.
Is that better than having it go to an app on your phone that looks your...
That's what I'm describing.
That's what it is, okay.
Yeah. So just having the right password protection and making sure you keep all of your important documents safe is really important.
If this gets complicated, just go to YouTube and watch subjects on this over and over and over again, and it'll start making sense.
Yeah. Okay, so with that, that's everything that we have for today. I know we're a few minutes over, but we had a little bit of extra. Sure, go ahead.
Power of attorney. I just heard it from an estate attorney. They said that with the power of attorney, if your bank only has your name on it and your power of attorney person cannot get into your bank because if it has a beneficiary. Because the beneficiary is only valid if you're dead. But if you're incapacitated, they won't let you, the bank will not let you get into it with the power of attorney.
Interesting.
If there's a beneficiary.
Yeah. So you would change your bank account into your family trust or whatever you trust. Then your power of attorney can get into it.
Okay.
If it's just under your name, if it's beneficiary, you can't do it.
It's going to make it more difficult
Yes.
because there's another interested party.
Right. But beneficiary is only if you're dead. You
Right.
can only, yeah. So.
Very good point. Very good point. Yeah, we run into these things all the time.
Yeah, absolutely.
So go to the YouTube and watch some of these, and we'll stick around and answer any questions and bring any hard questions